do you see the change in the aggregate costs in the acquisition of value at risk in the equity markets over the last 20 years?
Wow, that is an excellent question. Well, I mean, Alex, I'm going to defer to you because I know you are a great expert in this particular space. What I would say is that it's interesting to notice how the clearinghouses have moved to a value at risk methodology. And I think most recently, if you look in the continent, LCH SA, which is the French-based Paris clearinghouse, which serves all of the Euronext ISINs, Euronext also a very well-respected market, they are recently moving from SPAN, which was the standard portfolio analysis of risk model. In fact, that was the model, Patrick, you may recall that Life used to use with LCH in the calculation and all those years ago, to a VAR model. And so I think with the VAR model, you tend to find that the potential calculation hopefully gives more transparency, but the margin is able to be calculated in a way that is more efficient. So I would happily, Alex, get your further feedback on your opinion on where you think that particular trend has gone.
Hi, Robert. Active versus passive. What's the outlook for the future?
Well, the beauty is choice is great for investors. The rise of passive indexation in terms of assets under management, all of the objective statistics show it growing very dramatically. But active stock picking still is in the majority in terms of values that are out there. So what we will see is both active and passive will continue to thrive. And as the humble market operator, we will continue to strive to constantly innovate to reduce the slippage cost, whether you're passive or active, to help contribute to long-term investment returns.
How do you manage to bring that all together into essentially one venue and still make it work?
Well, there are two ways to do it. You can slice it into little pieces and send them in a small amount to try and hide in plain sight, or you might actually decide to trade and you might have to wait a period of time till you find someone and then maybe price that quite far away from where you can actually see the particular touch. And this is where firms like Liquidnet and others have really innovated as brokers, where they've been able to get together a certain addressable liquidity and try to find out mechanisms where they can match together. So the feature of London Stock Exchange and Turquoise, London Stock Exchange as an exchange is broker neutral. And what that means is, while each broker in the community will do as much as they can, and they should, to try and match their existing customers together to give a better result, well, the largest global addressable pool will be in the broker neutral center. And with Liquidnet and others, what's special about London Stock Exchange and Turquoise is their comfort in being able to participate in the broker neutral center. And so with the small trades that happen, but a large value when you sum up a large number of small trades on the London Stock Exchange lit order book, and innovations like Turquoise Plato and Turquoise Plato Block Discovery that we're very grateful we have refined in partnership with the asset managers who've told us how they like to execute. They want a safe, quality price. They want to be treated fairly. They want to trade at the midpoint so the buyer and seller both get an equal benefit of potential price improvement, and to still do it in large size without market impact. That has been a phenomenal coming together of the community, of the value chain, the buy side, the sell side, and the humble market operator, to really innovate, to reduce that slippage cost, to give a complement to the lit order book that together work really well.